Holding company. What is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, and we're back with another installment of What is That? Where we discuss financial term and topics you may have heard, but we make them super easy to understand. Today, we're talking about holding companies. If you've ever thought about setting up a holding company to protect yourself or your assets, this is an important video you'll want to tune in. Holding companies. What is that? A holding company is typically a corporation or an LLC. It doesn't provide a product or service to the market. Essentially, what it does is it holds an interest in an asset. That asset might be the ownership of another company, or it might be real estate, or it might be stocks. So let's break that down. You might open a holding company in order to purchase shares of another company. For example, let's say your friend is starting a business and he wants to give you 20% of that business. Now, as an investor, you can choose to own those 20% in your personal name, or you can open up a holding company that will own the shares within the holding company. Here's another example. Let's say you want to purchase a piece of real estate. A holding company can purchase the real estate instead, collect rents, have expenses, and the asset is owned by the holding company. Last example. Let's say you're a serial entrepreneur and you have multiple businesses. You can own each of those businesses in your own name, or you can own them in the name of a holding company. The main advantage of a holding structure is to limit the financial and legal liability exposure that might be created by having that asset. It can also provide some privacy, right? If someone were to look up who owns this company and sees that another company owns that company, depending on the privacy laws of where the holding company was created, ultimately, you may not be able to find out who owns the holding company. From a liability standpoint, think loans and debt, you are limiting your personal liability by having loans and debt inside of a holding company instead of personally. This legal separation of both assets and liabilities allows for an owner to avoid issues should they experience financial troubles later on, whether personally or within the holding company. Now, depending on the type of structure, holding companies can actually create more tax returns for you and more annual filings with the respective states they're registered in. So holding companies are not for the faint of heart because they require so much more compliance and more tax filings. If you're a serial entrepreneur with multiple businesses, setting up the right structure is key to ensuring that the holding company is ultimately doing what you want it to do. This is why it's so important to work with a CPA on your structure before you file a single application. Many times I work with new clients to change their structure, which is so much more difficult after the fact because the structure that they initially set up based on advice that they did not get is wrong. We hope you enjoy this latest installment of What is That? Hit the like button, subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.